Hello, good morning to all. Welcome to Global Online. Here we are discussing NTA UGC Net 2023 Paper 2 Economics, and today we are discussing about monetary policy. And monetary policy is an important policy that governed by RBI, and we discussing also instruments and working of the policy. Before we moving ahead, a quick look at what Global Online offering for you. We provide full syllabus video lectures and live lectures and also notes, mock test and solved PYQs with solution. And those who are interested to join with us, please contact with the given WhatsApp number. It will really helpful to crack your exam in very first attempt. And first we discuss two MCQs related with monetary policy. First one, which of the following is a selective credit control method? Options are RBI directives, bank rates, open market operation, cash reserve ratio. And the next one is the primary purpose of the RBI monetary policy is to maintain wealth, exchange rate, income inequality and price stability. And the answer for this question we will discuss later after the session. First one, what's monetary policy? Monetary policy is a set of tools used by nation central bank. So it is the policy that used by central bank to control overall money supply in our economy and thereby promote economic growth. And to promote this economic growth, we want to employ strategies such as revising interest rate and bank reserve requirements. And there are mainly two types of monetary policy. First one is expansionary and the second one is contractionary monetary policy. So, in the first slide, we looked at monetary policy is the policy used by nation central bank and is to control overall money supply and thereby promote economic growth in our country. And for this, we employ strategies such as revising interest rate and changing bank reserve requirements. There are two types of monetary policy, expansionary and contractionary. And the monetary policy is the control of the quantity of money available in the economy, and also the new supply is controlled. Also the channels by which new money is supplied. Economic statistics such as GDP, the rate of inflation, the industry and sector specific economic growth rates influence monetary policy strategy. So these are the factors that will influence the monetary policy strategy. GDP, rate of inflation, industry and sector specific growth rates. And the next one, types of monetary policy. Either expansionary or contractionary monetary policy we will apply in our economy, that will depending upon the level of growth or stagnation within the economy. First one is contractionary. Contractionary in the sense that will reduce the economic growth, thereby making the money supply controlled. So we want to increase the interest rate and thereby limit the outstanding money supply to slow growth and decrease inflation. So whenever there is inflation or over money supply, the RBI will make monetary policy as contractionary and thereby make the prices of goods and services in the economy to rise and thereby reduce the purchasing power of money. So it will help the economy to control money supply and thereby get an equilibrium in the money supply, overall money supply of the economy. And the next one is expansionary. Expansionary, at the time of slowdown or a recession or a deflation, the RBI will lower the interest rate and thereby making saving becomes less attractive and also consumer spending and borrowing increases. So it will make the economic growth increase level, and for this we employ expansionary policy. So it will reduce the interest rate and thereby making the saving less attractive and increase the consumer spending and borrowing. Okay, next one, goals of monetary policy. We all discuss about what is monetary policy, its tools, and then we want to discuss goals of monetary policy. Why or what the monetary policy or what is its goal related with it. First one is inflation. That's inflation is controlled by making monetary policy or introducing expansionary or contractionary monetary policy. First one is inflation. And the inflation in the sense is used to target a high level of inflation and reduce the level of money circulating in the economy. So whenever there is a high level of inflation, RBI will make contractionary policy or it will reduce the it will increase the interest rate and thereby reduce the level of money circulating in the economy. Okay, next one is unemployment. And in unemployment, there happens where in the economy when there is deflation. So deflation in the sense there is recession in the economy. So it will make the life of the people in hardship. So we want to increase the money supply in our economy. So we want to employ expansionary monetary policy. So it will decrease the unemployment and increase employment rate. As a higher money supply and attractive interest rate stimulates the business activities and thereby make many job opportunities in the job market. So it will reduce unemployment rate or it will either make employment rate in a expanded way. Okay. So it's another goal. And the next goal is exchange rate. Exchange rate will shows the relationship between domestic and foreign currencies. So the relationship between these domestic and foreign currency can also be affected by monetary policy. With an increase in the money supply, the domestic currency becomes cheaper than its foreign exchange. Okay. So with an increase in this money supply means when there is inflation, the domestic currency becomes cheaper because everyone have lots of money supply and all have the purchasing power in the high level. So they will make the domestic currency in the cheaper sense than the foreign exchange with relation to foreign exchange. Okay, so we want to make our currency uh, richer or we want to make the foreign exchange in a equilibrium level. We want to employ the exchange rate or the monetary policy in a better way, either expansionary or contractionary. Okay. And next one is tools of monetary policy, an important portion in the monetary policy. There are two types of tools in monetary policy. First one is quantitative and the other one is qualitative. And in quantitative, there is a stringent measure or strict measure by RBI to govern or to regulate the money supply in our economy. And first one is open market operation. In open market operation, it shows RBI's buying and selling of bonds and securities, and that from investors or sells additional bonds to investors. Investors in the sense it's commercial bank and also the other institution that will deal with the financial terms. Okay, and to change the number of outstanding government securities and money available to the economy as a whole. So we want to know what's the RBI buying and also what is the RBI selling will lead to the regulation in the money supply. Whenever there is inflation, there is lots of money supply in our economy. So the RBI want to regulate the money supply by buying the securities. Okay, so it want to the commercial banks will pay money back. Okay, and in selling means the RBI sells the securities. So here selling will lead to in the period of inflation and buying in the sense it will leads to the deflation. Okay, so commercial bank gives money in return of securities in the period of inflation and RBI will provide money in return of securities in the period of deflation. So it will regulate the money supply in the economy. So RBI buying means securities buying. So RBI want the securities, not the money. So here buying sense means expansionary policy, and in selling sense RBI will employ a contractionary policy. Okay. Next one is interest rate. The central bank may change the interest rate or the required collateral that it demands. The rate is also known as discount rate. So the discount rate or the interest rates will make the money supply in the economy regulated. So banks will get loan more or less freely depending on this interest rate. According to the interest rates, banks will get loan from RBI, and that will be in higher or in lower interest rate according to the period, either in inflation or in deflation. So in inflation, the interest rate is very high, and the commercial banks will get only a small amount of loan, and in period of deflation the interest rate is very low and commercial bank will get higher money supply, and also they can provide it to customers. And the next one is reserve requirement. And in the reserve requirements means that the commercial banks want to park some of their portion of deposit in RBI to meet their liabilities whenever required. So, in commercial banks, number of customers make NPAs because they did not pay the interest rate in return of their loan. So it will make NPA in commercial banks, though, so they cannot meet their liabilities. At that time, RBI will help the commercial banks according to the reserve requirements in the RBI, according to their reserve requirements. So lowering these reserve requirements releases more capital because commercial bank only need to make a smaller amount in RBI, and whenever the requirement increases, it curtails the bank lending and slows the credit supply to commercial banks. So lowering will make the more releasing of capital, and increasing the requirement will curtails the bank lending because they did not get much money to lend or to borrow. And the next one is repo and reverse repo rate. The term repo and reverse repo will confuse you during your exam time because it seems like same, but its meaning and also its definition are different. Repo rate is the rate at which commercial bank borrow money by selling their securities to the RBI to maintain their liquidity. So here commercial banks borrow money by selling their securities. So here commercial bank get money from RBI in return of selling securities. And in reverse repo rate, here the time of higher inflation, and in repo rate, we see that commercial bank get the money from RBI, and also the money supply increases or it makes disequilibrium in the economy by higher inflation in the country. At that time, RBI increases the reverse repo rate, just opposite to the repo rate. That encourages the bank to park more funds with RBI, so which will help it earn higher returns on excess funds. So it will control the money supply. So repo rate is the policy of expansionary monetary policy, and reverse repo rate is the contractionary monetary policy to control the higher inflation in the economy. So next time, do not make confusion in these two terms, repo rate and reverse repo rate. Okay. And then we entered into the next point, that is qualitative tools of monetary policy. First one is rationing of credit. Here, RBI fixes a credit amount to be granted for commercial banks, that we will all know, and the credit limiting means it will be limited by the RBI because they want to more responsible towards the money supply in the economy. So limiting the amount available for each commercial bank by RBI to make the money supply in the economy in equilibrium. Okay. And in next one, consumer credit. Here, credit supply is regulated through the installment of sale and here purchase of consumer goods. So here we will regulate the purchase and sale of consumer goods. Features like installment amount and down payment etc. all will fixed by in advance by the required authorities. Okay. And the next one is change in margin requirement. And in margin here refers to certain portion of the loan amount. So this is not offered or financed by the bank. Okay, so here bank is a central bank. Okay, RBI. So the RBI will not offer or finance the certain portion of the loan amount. It will just give the loan to the commercial bank, and commercial bank will uh, fix a certain portion of their loan amount as a margin, and in change in margin will make change in the loan size. You get it? And this instrument is used to encourage the credit supply for the necessary sectors and avoid it for the unnecessary sectors. This term is really important here because the banks all know about necessary sectors, but they did not mind about the unnecessary sectors. So it will create more NPAs. So after by setting the margin, the bank really affordable to give the money to the necessary sectors and avoid the unnecessary sectors. Okay, and these are the measure, and also the other one is simply moral suasion. Here the RBI did not employ any strict or any stringent measures to regulate the money supply. It will just give suggestion, or it will make a moral talk to the commercial banks to regulate the money supply, so that they cannot give a stringent measure. So it will make the commercial bank so easy to control their monetary policy, their money supply. So according to this moral solution that helps in restraining the credits in the inflationary period. So here RBI implies pressure on the Indian banking system without taking any strict action for compliance with rules. So here does not contain any complicated rules or rules. It will just give a suggestion to commercial bank to regulate their money supply. Okay, and we move to our question. First one is, which of the following is a selective credit control method? Here selective credit control method means it want to be selected by the RBI. So here RBI is given in the option RBI directives. So the answer to the question RBI directives. Okay, selective means here RBI directives. Bank rate, open market, cash reserve, these are the tools of quantitative monetary policy. And here selective credit control is the separate tool that used to regulate money supply in the economy. Okay. Next question. The primary purpose of the RBI monetary policy is to maintain. So here we want to answer primary purpose. There are number of purposes for RBI to impose monetary policy. So here the option given wealth, exchange rate, income inequality, price stability, etc. So here these all are the purposes that related to the monetary policy. But we want to select the correct answer for the question, that is primary purpose, and the answer is price stability. Okay. So here price stability is the answer for the question, that is primary purpose of the RBI. And the price stability here means whenever the price disequilibrated or it makes changes, it will also make changes in the income of the consumer also. Whenever for a product that increase the price, it will make changes in the income of the consumer also. So it will make problems by the disequilibrated price. So we want to first of all make the price stability, and then we move to the income equality, and later we move to the money supply regulated. Okay, so these are the things that we deal today, and we end with a thought. It always seems impossible until it's done. Thought by Nelson Mandela, and world leader from South Africa. We will end with this session. Okay, and any doubts related to this session, please ask in the comment box. And all are all topics related to this session you will refer and also to study well. And we wind up this session with the thought. Thank you. Have a nice day.